Hello everyone, welcome back to my channel. Today I'm going to do an analysis of a property that a client asked me to do, and this is for a property in Waterkloof Ridge, Pretoria. It's a 4.8 million or 4.79 million property, and we're going to compare it to an investment as I've done before. So as you can see, there's the price 4790. The property is in an upmarket suburb. It's filled with embassies and high-end houses. It's situated in an estate with 8 units. Waterkloof Ridge, Pretoria. It's a 3-bedroom, 3-bathroom property. All 3 bedrooms are en suite. It's quite a nice property. I can't show you pictures, unfortunately, it's confidential, but it's quite a nice property. Note that this property has got no transfer fees, no bond, and no deposit because the client is paying it cash, or he wants to pay it cash and he wants to see if this is a viable investment. Let's look at the rental income scenario. The rental income offered on this property is 26,500 after agent fees, so that's 318,000 per annum. The total monthly expenses is 7,183.25, which is the municipal rates and taxes and the levies combined. The water and electricity, should this property be rented out, is for the tenant's account, so the owner or the landlord doesn't pay the electricity on this account. So in order for us to determine the property growth rate on this property, I used the Lightstone report, which is available publicly. Luxury property in South Africa grew at 3.5%. Luxury, according to Lightstone, is values above 1.5 million. There are different breakdowns of properties when you look at F&B, property index and all of that, but we're just going to focus on the Lightstone report here, which is quite accurate. The non-coast property values grew at 2.3%. In other words, properties that are not on the coast, like KZN or let's call it Durban and Western Cape. City of Tshwane property values grew by 1.6% on average, and the Gauteng property values grew by 1.2% on average. Now, the average between all these figures, if we combine them, is 2.15%. I feel that is a bit low for an upmarket property. We do want a realistic reflection of what the property can grow at if it's a nice property in a nice area. So I felt that I've adjusted it slightly upwards. Remember, the purpose of this video is to determine if a property is a better investment than an alternative investment, which I'll go into more detail later. And that's why we try to be realistic. We give the property in this area and grows quite well, so we give it a little bit of a chance. Here's the Lightstone property report. Here you can see the 3.5% growth rate for luxury properties, non-coast 2.3%, City of Tshwane 1.6%, and Gauteng 1.2%. I take all 4 of those and I create an average. If we look at the rental increase per annum in South Africa, 4.2%, as you can see according to PayProp. This figure is slightly outdated. I see the latest figures are slightly higher at 4.6%. That's not much higher, but that's apparently the highest it's been in a couple of years. So we're going to use the 4.2%. The calculation that I've done here was done a few months ago, and I only got time now to record this video. The following 2 slides are screenshots from the property portion of the Excel calculator. Let's have a look at this. There's your 4.79 million purchase price. Loan amount is 0. Annual interest rate 0 because there's no loan. Amortization 240 months, but there's no bond on it, so that doesn't matter. Purchase date or start date in this case is 1 January 2024, and then the rental income per month is 26,500 after fees. Some further assumptions. So here's the property growth per annum that I've discussed earlier. If I use the Lightstone property index, it shows 2.15%. And I thought, you know what, this suburb is quite well looked after, and it is in a high-end area, and let's give it a benefit of the doubt, 4.15%. It just makes it a more fairer comparison. There's the rental increase per annum at 4.2% as discussed, and then levy rates and tax insurance increase per annum at 6%. The tax rate on the rental income, in this case we're going to use 0%. Now I've done 2 analyses on this case, and on the other one I've used actual tax on the rental income, which is more accurate than a 0% tax. But I want to show you the difference between that. Even with 0 tax, the property might not be such a good investment compared to an alternative investment. So I'm going to open the Excel file now to show you the investment side of things. A lot of you are interested, how does that work? It's an endowment. Endowment means the investment is taxed inside the investment. It's not taxed in your name, so the tax is already deducted. We also assume that this endowment is invested in a capital nature. In other words, it's got a lot of equity exposure or only equity exposure in it, because endowments are usually long-term investments, the same as a property. Now, I'm going to show you the figures now on the Excel. So in this case, it's a 20-year investment, 4.79 million gets invested, and the growth rate we're going to use is 10%, which is quite moderate if you invest aggressively long-term. So 10% return. This is pre-tax. So I'll show you what the effect of the tax is. In a personal endowment, if you invest of a capital nature, in other words, if your underlying assets are mainly equity, your effective capital gains tax rate inside the endowment is about 12%. So I'm going to show you what that looks like. So here you can see the deposit was 479 million and it's a 479 growth rate in year one, and that's your balance. You can see the cumulative growth that builds up. Here's what you can see, what adds up every year, and then your total balance here pre-tax. Now on the right hand side of this calculator, I've built in the tax amount here, and then it deducts the tax every year that gets accumulated. So we get a snapshot of how much money you will have after tax if you had to pay out the endowment, pay out the investment yourself. So let's look at after 8 years, for example, you should have had 10.2 million if there was no tax, and now after 8 years you'll have 9.6 million due to the tax. So we're going to use the after-tax figures when we take this and compare it to the property investment, or having to buy the property instead of doing this investment, and we'll look at the outcome just now. So before I'm going to show you the outcome of the two comparisons, I'm going to show you what the property calculator looks like in detail. Let me give you a breakdown of that. So here you can see the property calculator. I'm going to scroll down. There are all the assumptions that we discussed previously. There's a little note that I've written about it. And here I can either change the tax on the rental income to 0 or to 27, which will be property income tax. And note the rental tax that I've used is the tax after expenses. In other words, if the rental income is 10,000 and the expenses are 5,000, the tax only gets applied to the 5,000. Now, we can only do it that way. There's a couple of other factors. For example, if you have expenses against the property, that helps you in addition to this. But we already gave the property a benefit of the doubt here with a higher growth rate than what is on the Lightstone property. So I don't want to make too many changes to that. So if we go down to the rental income, here you can see the rental income accumulates. Every month it's 26,500. Then a year later it goes up by 4.2%. That's in month 13. To the right hand side, you can see the accumulated rent. After a year, you've got 318,000. There's the rate, taxes and levies. Insurance, 7,183 per month. There's the accumulated levies paid right there. Then the monthly cash flow. So that's your rental income minus all your costs. So you've made a cash flow positive of 19,000 Rand positive. And then the accumulated cash flow. After a year, you've made 231,801. Then if you look further to the right, what is your property value at the current growth rate? So after a year, your property should be worth about 4.971 million. In other words, it grew by the 4.1% that you can see up here. And then what is your net cash in hand at point of sale? In other words, if you sold your property after a year, you'll get 5.2 million Rand in your pocket. Remember, there's no bond on this property, so it's the amount you paid plus the rental income minus the expenses. Let's have a look at year 10. So month 120 on the left, and there you can see your rental income now is 38,000 Rand. Current accumulated rent received over the years is 3.8 million. You have 12,000 Rand per month, rates, taxes and levies. Your accumulated cost paid or rates, tax and levies are 1.1 million. Your cash flow per month positive is now 26,000 Rand. Your accumulated monthly cash flow at the moment positive is 2.7 million. The property value is 7.1 million at the moment. And the net cash in hand, in other words, if you had to sell your property, that's the property price plus the cash flow that you've generated positively, is at 9.8 million. Now, if we go to the investment case, after 10 years, you can see the case is 11.5 million. I mean, it sounds crazy. You get an income from the investment, or from the property, not from the investment, but the investment value is higher. But it's really explainable if you look at this. A compound interest is a very strong factor. And so, this carries on and on and on. You can see in year 15, the rates and taxes is 16,000 Rand a month. But obviously by this time your rental is 47,000 Rand a month. And you've accumulated a large amount of cash flow over time. If you had to sell your property, it's the 8 million plus the 4.4 million that you have accumulated in positive cash flow, so 13.24 million. So this slide gets a bit busy. I'm going to show you the comparison, the final comparison, where I take the Excel spreadsheet values for the property and for the investment, and I put them next to each other with different scenarios. So for example, on the left hand side, on the left here, this is the one where the property CGT is excluded. In other words, if you have to sell the property and not pay capital gains tax, you'll find that the property is the best scenario for the first 5 years, and then the investment is the better scenario. Remember, in this case, the investment the tax is already deducted. So it's 10% less than 12% tax on that 10%. Okay. Then if you look at the right, it's including property CGT. It brings the property down to the only first 2 years where it's beneficial, and then the investment becomes better. Now I'm just hiding this slide because I'm just going to read what it says behind me, and it's that we haven't done tax. We haven't added tax into this calculation on the rental income tax profit. So once I add that to the property scenario, you'll see that the case gets worse for the property, and which I'll show you on the next slide. So on the left hand side here, you can see it's the comparison where CGT is still excluded, in other words capital gains tax, when you sell your property. However, the rental income tax is already included. You can see that the green means the property never becomes a better option than an investment. After 20 years, your property will give you 15.5 million, in other words, with the growth and the rental income profit that you've made over time after tax, and the investment will give you 26,298,000. It's about 10 million difference. On the right hand side, we include property capital gains tax, which now gets included in the sale, and in this case the investment stays the same, obviously, because there's no change to that. The investment shows all taxes already, and in this case the property shows a slightly lesser profit, so it's 11.8 million difference that you get. Now, another thing to remember, when you do a property investment, it is not a passive investment. You have to deal with tenants or agents. You have to sometimes do maintenance on the property. You have to make sure you abide by all the rules, all the taxes and all of that. But the investment I've showed you here is an investment where you don't have maintenance, you don't have taxes that you need to comply with. The tax is already calculated in the investment, and it grows with the underlying assets in your investment. Thanks for watching this video. Hope I added value. If I did add value, please hit that subscribe button, like the video, please share it with some friends and maybe debate it, ask me any questions in the comments, and always remember that the property purchase does have an emotional side to it, not just a financial side, and just make sure that if you give the emotional side a bit more weight in your decision, that you know what cost you're giving it at.